Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all our viewers tuning into the All English program. Hello, I'm securities analyst Shui Rencheng. It's not a bad thing, it's just that I haven't spoken for a year, so I accidentally said morning just now. Anyway, let's have a chat here. Yesterday, we actually talked about our 3 major stock categories, and in particular, we also mentioned stocks that are sensitive to inflation. Which stocks are those exactly? Today, we'll start by talking about consumer stocks. Then tomorrow, we'll probably be discussing the oil and energy sector. After that, the day after tomorrow, we'll focus on utilities. Actually, I should say industrials, and then also include sectors like materials. We'll also cover raw materials. On Friday, we'll discuss inflation-sensitive stocks. Tomorrow, Wednesday, we have non-farm payrolls, and Friday brings the CPI release. So, we'll cover payrolls tomorrow and the CPI on Friday. Just letting you know our plan for the next few days. And then next week is the Lunar New Year, right? So next Monday is New Year's Eve, and it just so happens that it's also Martin Luther King Jr. Day in the US. So basically, the markets there will be closed. So trading will only start again on Tuesday, which is the first day of the Lunar New Year, and I'll be speaking then as well. So I just wanted to give everyone a bit of a heads up and discuss what to expect going forward. Today, we're mainly going to share something important with everyone. Notice something yesterday. We mentioned the dollar would trend down, and it dropped sharply. Looking back, the dollar was clearly weak. Was that due to specific currencies or just general strengthening? It actually looks like it was simply the US dollar weakening on its own, because yesterday the euro, Swiss franc, Swedish krona, British pound, and Japanese yen were all strengthening. So this basically confirms that it was the dollar alone that was weakening. Now, with the dollar weakening, so we checked the time this morning, well, now it's afternoon, and found that the US dollar actually started weakening yesterday at around 7 p.m. Taiwan time. So let's work this out. 7 p.m. in Taiwan is basically 6 a.m. on the US East Coast. And then 6 in the morning on the US East Coast is actually when a lot of people on Wall Street start work. So that movement is even more likely to be related to Wall Street, since that's when they start making trading decisions at 6 o'clock. So to some extent, these trading decisions might be based on their expectations, like, is it possible that tomorrow's non-farm payrolls will come in below expectations? But actually, after 10 p.m. last night, their heads... He actually said something related to this, which is why we say that some people are trying to prepare in advance, thinking the non-farm payrolls might not look good. So what could this not good situation look like, and just how bad could it get? We'll discuss that with everyone, and then we'll also talk about which stocks are considered core consumer stocks. Today, we'll give a few examples to discuss with everyone why we focus on these particular stocks and what their individual strengths are. We'll talk about how to really look at core consumer stocks, and when you're picking stocks, what perspectives you should consider. And also, what are the reasons driving the current market participants to decide to buy these stocks? Why do these particular stocks show relatively stronger performance? This is another aspect we'll be discussing with everyone today. Alright, next up, this is pretty interesting. Google has, for the first time, issued bonds denominated in British pounds and Swiss francs, and among these, there are even so-called 100-year bonds. Previously, they had already issued about $20 billion in the US. And then the subscription size was about 1.1 trillion, so that's basically 5 times oversubscribed. Right now, it looks like the subscription speed for the Swiss franc and British pound bonds will also be extremely fast. In a way, this means that Google is using multi-currency issuance to diversify its own exchange rate risk. And also, at the same time, this investment could be considered a way for them to diversify their investments for the future. Right now, Google hasn't completely ruled out the idea of setting up data centers in Europe, so it's possible that the main reason for this bond issuance is to support the establishment of data centers in Europe. Over there, they directly mentioned that it's actually possible that this year, Europe and the US might have even further conflicts regarding so-called digital sovereignty or digital-related regulatory standards. So in a way, they're giving you a heads up in advance. Basically, this year Europe and the US will probably be arguing again, so the US might say it wants to slap tariffs on Europe or impose capital controls, so everyone should be prepared in advance. There will be a lot of turmoil and disputes between Europe and the US this year. Because, like J.D. Vance just mentioned, he said that basically the discussions about Greenland are still at a very, very early stage, so this is completely different from what Trump said before. So sometimes when everyone hears Trump making related statements, I have to say just take it with a grain of salt, because sometimes he tends to exaggerate quite a bit. For example, he previously said we were about to reach an agreement or something, but it's already been a month since he said that. Yeah, it's been about a month now. Nothing has happened, and then JDM just said, oh, we're still in the early stages. So basically, this is a rather awkward situation. But because of this, it actually means that for Europe, this will be a very long-term process of change. So in the long run, European capital might gradually start to withdraw from the US, or at least European capital won't flow into the US like it did in the past. So for the European stock market, this can be seen as a potential driver for growth. And for the US, it just means one less source of potential buying power. So everyone should pay special attention to this possible situation, and at the same time, as long as you have a diversified portfolio. That basically means, for yourself, if you have euro allocations, my suggestion is to hold on to your euro positions for the long term, especially if you simply hold euros. I also recommend holding them long term, because the euro could very well appreciate over the long run. When the euro is appreciating over the long term, holding euros not only significantly boosts your own purchasing power, but also, I believe for most people, the chances of traveling to Europe in the coming years are probably higher than going to the US, so the relative cost of holding euros is definitely lower than holding US dollars. If you only go to the US, you need US dollars, but the relative cost is lower because by holding euros, not only can you benefit from the capital gains and the exchange rate differences, but when you spend money in Europe, you won't have to face the pressure of exchanging currency and dealing with potentially unfavorable exchange rates at that time. So here, I personally would strongly recommend that when allocating between euros and US dollars, you should still have some allocation to euros. Whether you simply hold euros directly or hold them through European stocks, you should have some exposure. Either approach is, in my opinion, a pretty good strategy. This is more from the perspective of long-term asset allocation, so I offer this as a reference for everyone. Okay, as for Google, I think part of the reason might be this. From Google's perspective, they might be concerned about their overseas investments, their investments in data centers, and their overall investments related to AI. They might not be using 100% US dollars because they may also be considering building in Europe, so when they think about building in Europe and issue US dollars to convert to euros, for them there could be some exchange rate issues, and it could cause some trouble in their accounting records. He has a problem because it's like he's borrowing in US dollars, but when he spends, if you look at it from a balance sheet perspective, his liabilities are indeed in the US, but all his expenses are in Europe. And then, if the money he gets is in US dollars, actually that's not entirely advantageous for him. But if he holds European bonds, whether they're in pounds sterling or Swiss francs, since he's holding assets in Europe, his currency risk is, to some extent, actually diversified. This allows for effective diversification, so this might be a long-term consideration for their company's balance sheet. That is, issuing debt in the local currency, so their liabilities are in that currency, and all the income they receive is basically in euros. He receives Swiss francs or British pounds, and when he pays back the debt, it's also in those currencies. So essentially, he can avoid some of the potential losses related to currency fluctuations, basically the potential volatility. So whichever direction it goes, the main purpose is to help him avoid the long-term risks of exchange rate fluctuations. That's the main consideration. Strictly speaking, the real issue here is the US dollar. If the dollar's weak over the long term, and he issues bonds in US dollars and then earns euros, it might actually be more profitable for him. That's because if the dollar keeps weakening, when he earns euros and exchanges them for dollars, he'll get more dollars in return. It would actually be easier for him to repay his dollar-denominated debt. In theory, that's how it should work. But instead, he chose to issue bonds in Europe, so he probably did it to keep his overall exchange rate exposure more stable. So when Google chooses to do this, it actually gives us something to think about in terms of our own investment strategies. So you can also think along these lines. Have you considered that when your own assets reach a certain scale, maybe holding some euro-denominated assets could be beneficial for you? On one hand, you might be able to profit from exchange rate differences, but on the other hand, it could also help you manage your spending more effectively. Alright, and then tonight at 9:30, so in about 20 minutes, we'll all take a look at the retail sales figures. Currently, the market expects a 0.4% increase. Then at 1 o'clock a.m., there will be another release, and at 2 o'clock a.m., it's Logan's turn. Alright, and the main point is that Hessett mentioned that, so the slowdown in the US population means it's only natural for transaction data to decrease in the coming months. This statement is like a super preventative shot. What does that mean? Basically, starting from this month and for the next few months, in fact, to put it plainly, the way he said it, it sounds like almost 2 quarters. There's a very low chance of strong non-farm payroll numbers in the first half of this year. It's even possible that non-farm payrolls will continue to decline. There's a chance they'll keep dropping. And he's suggesting that there might be slightly fewer jobs than what would match a high GDP growth rate. Actually, this statement's a bit subtle because logically, if your GDP growth is high, it means your C, consumption, G, government spending, or I, investment, are all growing rapidly. So theoretically, employment shouldn't be that low. But he's using this kind of nuanced idea. And the reason is, because productivity growth is skyrocketing. Let me just say, all of this is political talk. These are all political statements. Basically what they're saying is, if in the future you see non-farm payrolls going down, don't worry, because we Americans have excellent productivity right now. Why? Because AI has driven a huge boost in productivity. He's basically giving a very, very strong heads up in advance, so it's like he's preparing for what's to come. He's trying to completely eliminate all future market expectations regarding non-farm payrolls. He's doing this expectation management, and he's doing it very aggressively. Because when expectation management is taken to this level, people might start to focus on, hey, what's actually going to happen with the unemployment rate? But basically, the unemployment rate shouldn't increase significantly, because the departure of undocumented immigrants is a very important factor. So it's really about both supply and demand sides. Demand is declining. Labor demand is falling, but supply is also decreasing, so the unemployment rate should stay balanced. The estimate is 4.4, and tomorrow's numbers should reflect that. But since non-farm payrolls might keep dropping, he's essentially advising us not to focus on them anymore. We should just glance at them. The rate of decline, so basically what he hopes is that if the market really takes this message to heart, then if tomorrow's non-farm payrolls actually come in below expectations, there's no need for everyone to panic too much. That's because the market might care more about looking at the unemployment rate. If the unemployment rate stays the same or even drops, then for the market it basically means, the job market is relatively stable. So this precautionary statement is actually meant to downplay the impact of the non-farm payroll data. Alright. Then he said, the reason why the equilibrium rate will be much lower than during Biden's time is because he believes. So this statement is just political talk again. To put it more bluntly, it's simply because there aren't enough people. Let me be very straightforward. There just aren't enough people. He makes all these statements as if America's productivity has skyrocketed, as if everything in the US is going great, but that's really not the case at all. You can actually see this from the JOLTS data. The JOLTS numbers have indeed dropped sharply, so this means that the demand for labor has fallen significantly, but the supply of labor has almost disappeared as well. Because of illegal immigration, or immigration in general, whether it's legal, illegal, or all kinds of other population factors, overall the population is actually decreasing. So under these circumstances, the unemployment rate itself is unlikely to rise significantly. Because the supply and demand for jobs has always remained balanced, it's just that both sides are declining. So when I specifically focus on this issue, basically non-farm payrolls and the JOLTS report have less and less influence on the overall stock market. Their impact will keep getting smaller and smaller, so this is definitely a direction everyone should pay special attention to. So this is just a heads up in advance. Including non-farm payrolls in the overall economic outlook might not be ideal, but this not ideal situation is all within expectations. The Fed uses this approach to ease any potential unease in the market. So when the data is released tomorrow, how the market reacts will become very important. And when the non-farm payroll numbers come out, the market's reaction might not be clear right away. Even the 5-minute K-line at that moment might not be accurate. You might have to wait until about half an hour after the market opens to really see the response. If the market remains stable or even continues to inch upward, that means the market isn't reacting negatively at all. The market is basically buying this. The market is fully accepting it. If that's the case, then for the final outcome, as long as there isn't a major downturn, what could go wrong? As long as we don't see some crazy numbers like a drop of 100,000 or 200,000 jobs, basically, as long as the non-farm payrolls are relatively steady, the market can totally accept it. All right, and let me show you this as well. The blue line here is from Brembo. They made a forecast, did an estimate. You can see here, it really does follow the same trend. The curve, the overall trend of this line, matches the movement of the non-farm payrolls. It's very close. It doesn't completely overlap, but it's very close, so you can see that here. In the past few months, there was a small rebound here, a minor bounce. It first declined and then rebounded, so this does match the current situation. Over the past few months, it kept coming down, and then just recently, there was a little bounce back up. So here, the market is currently estimating that tomorrow's non-farm payrolls will come out at around 68,000. Just by looking at this chart, you can infer one thing. Even if it's below expectations, it should still be above zero. In other words, it's unlikely to be a situation of a sharp decline. A sharp drop is unlikely, so even if it's below market expectations, it should still be a positive number. And the difference from the previous value probably won't be too big. So right now, with HESE given this kind of heads up, it's possible that they've already seen the non-farm data. Actually, they probably have already seen it by now, because according to their own procedures, the numbers should already be calculated at this point. So it's possible that HESY has already seen it, which is why they're given a heads up. But this number is likely still above zero, so the market might end up buying into this story. So when the non-farm payrolls are released tomorrow, my suggestion is that everyone shouldn't overreact. I would recommend not overreacting, because basically the impact is likely to be limited. The potential impact is relatively limited. It all depends on the unemployment rate. If the unemployment rate remains stable, then basically tomorrow's entire employment report can be considered safe, as in, it passes. Then we'll look at CPI. As long as there isn't a significant and obvious increase, the market will likely stay relatively steady. So basically, this data week can be considered to have passed safely. With that, next week will be a quieter one. There really isn't much going on next week. Fewer earnings reports and almost no major data releases. So the situation is that next week should be relatively stable. Then we'll be getting ready for the last big event, which is NVIDIA's earnings week. So for now, just keep this in mind. Tomorrow, when the market opens and the data comes out, as long as it's not negative from the market's perspective, and if the numbers come out just slightly negative, hopefully the market's reaction won't be too extreme. Alright, and here's another reminder for everyone. In the short term, margin financing funds are actually pulling out. This basically means momentum is fading. This is related to momentum trading. For example, this chart here corresponds to momentum trading because those of you attending online or in person should have seen this before. Actually, this chart is about showing the overall margin financing interest rate situation for institutions in the US. The higher the line goes, the higher the margin financing rate, which means more people are borrowing money from margin trading. The lower the line goes, the lower the margin financing rate, which means people are borrowing relatively less money. So you can see that even with the big rally in the US stock market yesterday, this indicator actually moved downward. This means that quite a few institutional investors took advantage of yesterday's surge to pull out instead. There are still some who pulled out. Does this mean there will be a big drop coming? Not necessarily. Instead, what it suggests is that it might be a bit difficult for the market to keep pushing upward. You can see this during the decline from October to November. The margin financing rate was still okay here, but from the end of November to December, the whole base dropped sharply. At that time, did the US stock market experience a big drop? Now, there wasn't. There were only big eyelashes, but there was no SMP, and there wasn't any significant body hair either. But what happened after that was that the market couldn't really go up anymore. It just couldn't rise much. So basically, what this capital flow mainly reflects is one thing. It's possible that there just isn't enough extra momentum trading capital. It might not be enough, so here's a suggestion for everyone. If the stocks you're holding are the kind that really rely on momentum trading, the kind that just keep rolling upward, there's a chance that going forward, they'll be more likely to just move sideways. As for stocks that have already dropped and are now rebounding, the chances of them continuing to surge upward and hit new all-time highs might be lower. So it really depends on your own holdings. If you're holding stocks we recommended a long time ago, like Parity, when we first recommended it, for example, it was in the $80-something range. Back then, when we first recommended it, it was around $80-something. So if you bought in at that time, and now you see a slight rebound here, I would suggest gradually reducing your position. Do it slowly, because expecting it to break new highs and shoot up to $200 again is unlikely. Getting back up to over $200 is probably going to be pretty tough, really quite tough, because honestly, most of the margin financing and capital here is mainly used for these super speculative trades, chasing high beta stocks and focusing on those tech stocks. It's mostly those small cap tech stocks or the more volatile tech stocks. As for the big industrial stocks, consumer stocks, or core consumer names, they actually don't use margin financing for those, not at all. So here, the financing's much more targeted toward those high beta stocks. This is just for your reference, because institutional investors have actually started to gradually pull out from this area. Alright, and then yesterday someone asked me, "Oh, is margin financing data publicly available?" Well, you can find this information on Brembo, but I'm not sure if you can find it on other related information sites. Since it's available on Brembo, I might provide it from time to time. For example, when I say goodnight here, I should be able to share it with everyone, and on my morning call, I also occasionally provide it. Sometimes I also share it offline. I also mention this whenever there are particularly unusual or special developments, so I might provide the information then as well. So it's not entirely clear whether it's fully public or not, so I can only give you this perspective. I also hope you can regularly tune in to our group's goodnight sessions, and if possible, you're welcome to join our morning call as well, because we always cover these topics in our related programs. We provide this kind of information as a reference for everyone, and if not, during our offline meetups or information sessions, I usually present as the main speaker and might also provide this information if someone asks. In future talks, I'll probably include this chart to share the latest perspectives for everyone's reference. That's basically it. Everyone is also welcome to join our offline seminars. Alright, so yesterday someone asked me about Bitcoin, and my take on it is pretty straightforward. T-bed curve, so I think right now it's a bit like the T-bed curve valley. Basically, if you ask me whether there's going to be a big rally for Bitcoin coming up, I think that's pretty unlikely. I think it's pretty unlikely for Bitcoin to see a huge rally going forward. As long as Bitcoin doesn't keep breaking new lows, I already think that's pretty good. Honestly, if it just stops dropping further, I'd consider that great, because from a technical perspective, Bitcoin has already formed a massive top. If you look at it as an M pattern, since this is the daily chart, it's basically already formed a big M. The fact that it hasn't dropped proportionally further is already pretty impressive. So if you want to break through this neckline and start being bullish on Bitcoin again, the prerequisite is that you first have to get past this neckline. At the very least, it means you need to rise back up to 86,000. Only after you climb back to 86,000 should you start considering whether there's a chance for a recovery on the right side. Right, before this happens, we're actually going to stay pretty conservative about Bitcoin. We're leaning more conservative because Bitcoin itself is a relatively risky indicator. And as you can see, Bitcoin has broken through the bottom again and again, even breaking through this neckline. What about stocks? What about the stock market? Has the Nasdaq done that? Has the Russell 2000 done that? No, they haven't. Basically, even the Dow Jones is hitting new highs, Taiwan stocks are hitting new highs, Korean stocks are hitting new highs, and Japanese stocks are hitting new highs too. So there's a possibility that funds from the crypto market are flowing out and moving into the stock market. So this year, if you really want to focus on this area, personally, I'd say just don't touch Bitcoin at all. For me, I wouldn't touch it today. That's why Bitcoin-related concept stocks are also under relatively more pressure. because they're mostly watching Bitcoin. And on the contrary, since funds are flowing out of Bitcoin, the stock market's performance this year basically means there's another group of funds entering the market, and that group is the money flowing out from the crypto world. So for our stock market, in the long run, or at least for this year, this is actually a pretty positive development, because it means there's one less group of people competing with us for profits. So this means that for everyone trading stocks this year, you can, well, basically count on an extra source of funds, which can serve as a driving force to push up buying activity. Alright, so what are some stocks in the new consumer category? Let's first take a look at the YTD section. Actually, have you noticed? The first place is Bungie, second is Hostess, then Colgate, and then Constellation Brands, which is the company that sells alcohol. Then there's Macy's and ADM. This one is an agricultural products company, and so is this other one. The weakest performer is Estee Lauder, because Estee Lauder's financial report hasn't been good. Other than that, today you can also see General Mills, Dr. Pepper, and Campbell's. They sell broth, and this one sells spices. Overall, their performance this year hasn't been too bad. None of them have done terribly. So you can take a screenshot of this page if you want, or look up the relevant stock symbols yourself, because we won't be going through every single one today. We won't cover them all today. Alright, let's move on to the next page. Okay, so for MTD, we're looking at the situation since February. Since February, Hershey has performed the best, mainly because they released their financial report, and Kroger, KR, and then also Keurig is here as well. Pepsi also released its financial report, and Walmart hit a record high. As for Costco, they're about to release their financial report. Alright, now let's talk about Hershey. As you can see, Hershey appears in both the YTD and MTD lists, so I wanted to highlight it and explain a bit more. Hershey is a bit special. They make chocolate, cookies, candy, and chocolate products. Their sales in the US tonight are also quite good as far as I remember, although I know in Taiwan it might not be as popular. Not many people here really pay special attention to Hershey because it's not that closely connected to us. Maybe we've eaten some chocolate that happens to be from them, but in the end, for us, we're just not that familiar with the brand. But Hershey is actually doing well now, mainly because they've moved into the salty snacks segment, basically salty crackers and snacks. This category has seen pretty decent long-term growth. In the past, they've grown by 4.8%, mainly because of their consumers. For Americans, single-serve packaging is all about the price. While unit costs are higher, the total price is lower, making it a budget choice. Another factor is the demand for healthier foods. People worry sweets are too heavy, but with salty snacks like crackers, they think, well, it's not as bad for me. But honestly, the sodium content is actually pretty high too. Still, for Americans, maybe consuming less sugar is considered better. To put it simply, Americans are totally open to buying these products because they think they're pretty good. At the same time, they've actually acquired a lot of other companies, and through these acquisitions, they've used their own distribution channels to get products from those companies into places they couldn't reach before. So basically, they're expanding the overall brand scale and leveraging their entire retail network. Thanks to their retail connections, the products from the companies they've acquired are now distributed through channels and stores that those products couldn't access before. So basically, over the past year or so, Hershey has carried out a really effective structural reform. They also restructured their organization, redefined their brand positioning, and revamped their entire sales strategy. So for Hershey, I think to some extent, you could say it's been a complete transformation. I really think you could call it a complete transformation. And according to their latest financial report, they actually expect their revenue and profits to grow by 4 to 5% in 2026. I have to say, when people see 4 to 5%, they might think, well, that's not much. Aren't other companies growing by tens of percent? For example, today TSMC released their financial report, and their monthly revenue is truly astonishing. And if you look at Meta, Google, and those companies, they're all growing by double digits as well. So is this 4 to 5% growth really impressive? Actually, for them, it really is quite remarkable because at the end of the day, they're a core consumer company and their customers are just regular people's everyday spending habits. In this context, the fact that they can still grow is significant. 4 to 5% means they're experiencing very stable uplet growth. So it means that even when it comes to things like CapEx or certain special consumer cutbacks, they're still able to maintain this growth. When it comes to things like snacks or food-related spending, people can really cut back at any time, but usually these habits become ingrained. Once this sector starts to grow, it tends to become solidified, so the overall market size will keep expanding. That's why 4 to 5% growth is significant. It's actually considered quite substantial, and on top of that, they have enough buffer to handle any changes that might come their way. Also, they expect cocoa prices may keep rising. They'll end up with extra gains from their hedges, yielding additional profit. Their solid hedging keeps them protected even if prices go up. They also expect that international sales might see a slight decline in 2026, but that's just for international markets. In the US domestic market, however, growth is expected to be extremely impressive. So for Hershey, what's most important is actually the US domestic market. So as you can see here, in terms of organic growth rates, North America is very strong. For example, the salty snacks category is among the top 10, growing by 18%, which is really remarkable. And as for international, even though it's experiencing a slight decline, it's honestly not a big deal. Really, it's not, because you can see the scale here. North America is at 2.4 billion, while globally it is only 250 million, a tenfold difference. So when it comes to international strategy, it is really a minor issue, truly a minor issue. Anyway, the main point is whether the top 10 segment can continue to grow rapidly and significantly. For them, this might be an even more important direction for long-term development. So as long as you look at all the different figures in the financial report, let's take a look at the EPS for each year. Then looking at revenue and gross profit, basically 2025 might be relatively low across the board. Gross profit is relatively low, EPS is also relatively low, and revenue as well. So in terms of profitability, 2025 is not looking very good for them. With the worst likely over, it's estimated that from 2026 through 2028, EPS, gross profit, and revenue are all projected to trend upward. For these companies, the worst is likely behind them after a difficult few years. So soon, they'll be back on a growth track, and once they're on that growth trajectory, from the perspective of EPS, it's possible that their PE ratio will remain at around 28. Yes, that's possible, but their EPS could keep growing. So even if their PE doesn't go up, as long as their EPS keeps increasing, that alone can drive their overall stock price higher. And it's even possible that when the market starts to recognize the value of value stocks again, it's possible that the rise in their EPS could trigger a double boost in their stock price. Later on, the PE ratio might also rise along with it. This is something that can happen, because when the market starts to recognize value stocks again, that's when this situation will occur. So at the very least, there's a chance for it to challenge its previous all-time high. Or it might even set a new all-time high. This possibility is gradually emerging. So for these core consumer stocks, it really comes down to looking at whether their EPS can start to rebound, and whether their future growth might slowly begin to recover. As long as stocks like this house stock, start to see their EPS growing again, there's a chance that the overall momentum of their share price will pick up. And when momentum stocks start shifting from tech stocks to these kinds of value stocks, that's when you'll see this development take place. When you combine the momentum factor with value stocks, the effect it produces might be something none of us originally expected. So this is just something for everyone to consider. The reason I specifically brought up Hershey as an example is because I think it's a classic case. A value stock making a comeback with its EPS rebounding, its revenue picking up, and its fundamentals improving across the board. It's just a company that's turning things around on all fronts. Its chart looks even better. Basically, it's above the annual moving average and it's already started to form a bullish alignment. It's really showing a very beautiful bullish trend, and after entering this bullish phase, even when it pulled back to the annual moving average, it didn't stay below for long before climbing back up. It climbed back above the 20-day moving average and all the other key averages, so this in itself is a sign of strength. According to what Mr. Fan taught us, if a stock can quickly rebound after breaking above the annual moving average, that's a strong signal. It's a clear sign of a very strong stock. And this Haoshi stock is exactly that kind of stock. So here, my definition for it is that it has the potential to form a right side recovery. So this is just for your reference. When it comes to core consumer stocks, if you only look at individual stocks and you're not too comfortable trading them, you can just buy ETFs instead. But if you're willing to take the plunge and trade individual stocks, then I think this is one you should definitely keep an eye on. Oh, it's already 32 minutes in. Hold on a second. Let's quickly check the retail sales numbers. The market expected 0.4%, but the actual number just released is 0%, and the previous value was even revised. Sigh. So let's take a look at that. The US dollar just dropped quite noticeably. The dollar dropped pretty clearly. That means everyone's expectations for a dovish stance might be rising again. They're picking up again. Let me see if you can make this any shorter. Sorry about that. Let me check. Looking at the settlement, you can see that since it hadn't dropped that much just now, it means that everyone's expectations for a dovish stance have risen. Because retail sales also came in below expectations, which means the overall momentum of the US economy, especially consumer momentum, might not be that strong. Not that strong. So as for expectations of a rate cut, they might push them up. They might push up the expectations for a rate cut here. And as for, say, the entire stock market, the reaction should be relatively limited. In my opinion, it would be relatively limited. So everyone, just pay attention to this. Basically, tomorrow's non-farm payrolls report will be quite important. If tomorrow's non-farm numbers come in lower than market expectations, and as long as the unemployment rate doesn't spike significantly, then expectations for a rate cut will basically keep rising. That'll keep pushing expectations higher, which isn't entirely a bad thing for the stock market, but it's definitely good news for the bond market. As for the US dollar, it will likely continue to weaken, and so on. So this is something that could gradually play out. Alright, let's continue with the briefing. So looking at Bunge's earnings report for the fourth quarter was in line with expectations, but their outlook for 2026 isn't very strong. Still, the market responded very positively. And Bunge, everyone should have heard of them, right? ABCD refers to the four major agricultural companies, and Bunge is one of them. Another one is Admiral. Actually, only these two have gone public in recent years. The C&D companies haven't gone public, and one of them is European. Overall, for Bunge, the worst seems to be over. You can see here, we're looking at EPS, then revenue, and basically, the fundamentals are expected to keep improving over the next few years, and they have been steadily recovering. So for Bunge, the downturn of the past few years is pretty much over. It's basically finished. So if you look at the price-to-book ratio, you see, just like we looked at Hershey earlier, we analyzed it from the perspective of its EPS and overall profitability. But for Bunge, if you look at its PE ratio, it's actually quite expensive. But if you look at it from the perspective of price-to-book ratio, it's relatively low. Its price-to-book ratio is still only about 1.3 right now, just 1.3. Yet fundamentally, it controls some of the world's most important means of production, very important resources related to agriculture. So with such a low price-to-book ratio, when capital starts to recognize the value of value stocks again, this will become a safe haven for funds, and money may start to flow in this direction. So from this perspective, I think it also has a strong potential for a rebound on the right side. This is something for everyone to consider as a reference. As for the department store, they haven't released their financial report yet. The report will come out on March 3rd. Currently, the market estimates their EPS at 2.14. Plus, they've always had a price gap as a selling point, and their performance hasn't been great. Recently, there's news that they're starting to make some adjustments. Looking at their physical stores, what they're aiming for is to make sure that consumers feel more comfortable where they actually shop. This is actually a pretty positive cycle, especially as we move forward. When more and more consumption is focused on low prices, they can rely on their department stores. If they can improve the in-store shopping experience in this area, it will actually have a positive impact on their revenue. Also, this is a DPDP stock. Right now, its PE is only 15.3. If you're not looking at forward PE, just the current PE, it's 15.3. The forward PE is even lower. So in this situation, basically, yep, the market will have a few directions. One is that its fundamentals are comprehensively improving. Or the fundamentals might be improving, but its PE could be relatively high, yet it has a low price-to-book ratio. That's the second scenario. The third scenario is when the fundamentals are uncertain or it's unclear if they're improving, but the P is low and it matches a cyclical trend, like low-priced consumption is becoming more and more popular now, so it could actually benefit from that. So basically, when looking at core consumption, you can look at it from three angles. Its fundamentals are comprehensively improving, or the fundamentals are improving, but the valuation is relatively high, though its value is low. Are the conditions good or not? Then there's the scenario where both the valuation and the overall fundamentals are uncertain, but it fits the current trend, and at the same time, its PE is low, so that's another direction to consider. These three directions are for your reference. So overall, I think it also has the potential to challenge a right-side rebound situation. And then, because Walmart keeps hitting all-time highs, Walmart just keeps setting new records, its fundamentals are getting better and better, and it's highly valued, but it's also riding the right trend. So stocks like this actually hold a very strong position in the market. And then, if you look at it, for example, Pepsi and Coca-Cola, Coca-Cola just released its earnings report and its stock dropped, mainly because its outlook wasn't particularly impressive. But Pepsi, on the other hand, gave a very strong outlook, and its earnings performance was also good. So in the end, when it comes to Coca-Cola and Pepsi, maybe the market should consider Pepsi, because relatively speaking, Pepsi is showing a bit more strength. But from my personal perspective, if Coca-Cola experiences a more noticeable pullback, it could also be worth considering. After all, this year is a World Cup year. Wait, no, 2026 is the World Cup year. Anyway, during the World Cup, if people aren't drinking alcohol, everyone's going to be drinking cola. Yeah, it's a pretty stable demand, too. Alright, plus with the euro, it's basically been steadily trending upward. As for the euro, let's look at one more thing, maybe a bit later. Let's see when it stabilizes a bit more. European stocks hit new highs. Just like we said, European stocks should reach new highs, and sure enough, they keep climbing. There's really no surprise. They'll probably keep setting new records. The chances of them continuing to surge, in my opinion, are even higher than the Nasdaq. Then after that, they'll probably just fluctuate at those high levels. Alright, let's take a look at the pre-market situation. Safe. Right now, the stronger ones in tech are Spotify, their earnings report was excellent, and Datadog also had a really good earnings report. So this just shows that earnings reports still have an impact, so everyone should pay special attention to the earnings situation. Basically, if the stocks you hold are about to release earnings, well, it's up to you to decide if you want to take a gamble on them. Because basically, with Spotify, it really is just incredibly impressive, completely and totally beyond expectations. With Datadog too, if you look at the market's forecasts for it, you can see whether expectations are set really high. If they're not, basically, if it has a chance to beat expectations, then it will perform very strongly. Alright, and then the US dollar index continues to fluctuate downward. What are we watching for with the dollar index? If it breaks this level, I think it will actually. I believe it should hit a new low within the next 2 months, probably breaking lower. Okay, and then for US Treasury bonds, the 10-year is basically still hovering around here. The one that's more likely to drop should be the 2-year. Yeah. Right, the 2-year should rise more. The 2-year will probably go up more compared to the others. Alright, and then the whole US stock market. As for the S&P 500, it'll probably hit new highs in the next few weeks, but for the Nasdaq, I think it might be a bit tougher. The Nasdaq will have a harder time because it's still relatively far from its highs, and there's more resistance above. The one that's more likely to keep hitting new highs steadily over the long term should be the Dow Jones. Yeah. I think it's more likely that the Dow Jones will keep setting new highs, because like yesterday it surged again. It went up again yesterday. So I think the chances of the Dow Jones continuing to hit new highs are still pretty high. So as always, this is just for your reference. It basically means the divergence among the indexes is still ongoing. Then we'll see if the economic data ends up being the final catalyst. This is just for your reference. That's all for today's Equity Goodnight segment. Thank you all for watching, and I wish you smooth trading. See you again tomorrow. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.